Assalamualaikum and good day to everyone. We are from Group Believer and today we will present to you about accrued revenue and deferred revenue. Let me introduce our group mate. The first one is Aishwarya, Alifa, Maria, and the last one is me, Alia. Okay. Accrued revenue. What is accrued revenue? So, accrued revenue is a revenue that we have not yet received, but we have provided the good or services to our customer. This accrued revenue must be added in the revenue account and it is categorized under current asset. In our journal, we will debit accrued revenue and credit revenue account. The second one is deferred revenue. Deferred revenue is totally different from accrued revenue. So deferred revenue means the cash that we have received in advance, but we provide the goods or services to our customer later. Deferred revenue will be deducted from our revenue account and it will categorize under current liability. In our journal, we will debit revenue account and credit deferred revenue account. For our presentation, accrued revenue and deferred revenue under MFRS 15. For better understanding, let's watch some video about accrued revenue and deferred revenue.
Accrued revenue is money that you're owed for a product or service that you've already provided. This means you record the payment at the point of sale, even if the money isn't in your bank account yet. Let's use an example to demonstrate how it works. Imagine that you're in charge of an email marketing software. Customers use it to manage all of their email campaigns. They pay a monthly fee for the base plan. After using the software for a few months, some customers decide they'd like some advanced scheduling features to up their marketing game. So they log into their account and add some advanced features to their subscription. They get instant access to these features. They can start scheduling more emails, segmenting their audience, and more. But even though they have access to those features, they don't pay for them immediately. In fact, they won't pay for them until their next monthly payment. During this time, you record these add-ons as accrued revenue. When you receive the money at the end of the month, it becomes realized revenue. What is deferred revenue? Deferred revenue is when customers pay for a product or service that they haven't received yet. Instead of recording the funds as revenue, it's added to the balance sheet as deferred revenue. When you deliver the product or service, you can then record it as actual revenue. Deferred revenue is also classed as a liability on your balance sheet. If you're unable to deliver what the customer has paid for, you may owe the money back. So even though the customer has placed an order and sent their money, it doesn't mean you'll get to keep it. Booking a flight is a great example of how deferred revenue works. Let's say you work for an online provider. When a customer books a flight, their money goes straight to your bank account. But because their flight isn't until next month, you record the money as deferred revenue. When they take their flight next month, you can then move the funds from your balance sheet to your income statement. This is where it becomes actual revenue. Now,
So, the video explained about the scenario of accrued revenue and deferred revenue.
So now we proceed to the question 1. The following trial balance was extracted from the books of Syarikat Laila Akasha as at 31st December 2019. Under the trial balance, we just have 3 different items, which is a commission, interest on investment, and also rental. For additional information, first is accrued commission 300. Accrued commission, we know that as an asset because we do the action but we not yet receive the money. The money we not yet receive is our property. That's why we call the accrued commission is asset. Second, in interest revenue amounting to 500 was still not yet received. Interest revenue, we know that as a revenue, but this transaction, we recognize the interest revenue as a accrued revenue because this transaction just mentioned 500 was still not yet received. So this is similar like transaction A, which is accrued interest revenue. also as asset. Third is our unearned revenue, 930. Unearned revenue we call to as a deferred revenue. Deferred revenue is a liability because the income that you should get that year was over earned. So the balance must consider as liability under the deferred revenue. So we call the unearned revenue is a liability. So now the question asks we to prepare the financial statement, journal, ledger, statement or of profit and loss and other comparative income, and also statement of financial position.
Hello everyone, my name is Aisha Lingam Gaunde and my metric number is D2023-1109-025. So for now, I'm going to present the process of preparing financial statements after some adjustments are made. First of all, we have to do necessary journal entries from the additional information given. So in the additional number 1, they mentioned that accrued commission was 300. In the additional information number 1, they mentioned that accrued commission was 300. So we have to debit the accrued commission account 300 and credit the commission received account 300. In the explanation, we have to write commission not yet received. So additional information number 2, they said that interest on investment was not yet received. So interest not yet received means we already provide the service to them, but we haven't received the cash from them. So it's a type of accrued interest on investment. So we have to debit the accrued revenue 500 and then interest on investment revenue account in the credit side 500. In the explanation, we have to write interest on investment not yet received. The third additional information, they said that unearned rental received 930. So unearned, another word for unearned is deferred. Deferred means we receive the payment in advance but we haven't provided our service to the customers. So we have to debit the rental account 930 and then credit the deferred rental account 930. In the explanation, we have to write record deferred rental receipt. After that, we have to post it to the ledger accounts. So we have to open commission receipt account and accrued commission account. For commission receipt account, we have to take the bank balance 4,300 from the trial balance given. Uh, we have to put the bank in the credit side because commission receipt account is a type of revenue. So if an revenue increase means we record it in the credit side. And then accrued commission account 300 in the credit side because accrued commission it will also increase the commission receipt account. So that's why we record it in the credit side. 300, so 4,300 plus with 300 we get 4,600. So we have to balance it off and the balancing amount will go to the profit and loss account. The next one is accrued commission account. We have to debit the commission receipt account 300 because accrued commission is a type of asset. So if our asset increase means we record it in the debit side. So we have to balance it off and the balancing amount will go to the statement of financial position. So the next ledger account is interest on investment account. The credit side bank balance 5,000 we will take it from the trial balance and then accrued interest on investment 500. So this interest on investment is similar like we see in the previous slide because both are accrued revenue transactions. So both will be similar. So accrued interest on investment 500. So then we have to 5,000 plus with the 500 we will get 5,500. So we have to balance it off and balancing amount will go to the profit and loss account. So the next account is accrued interest on investment account. We have to debit the interest on investment account 500 because accrued interest on investment is a type of asset. So if an asset increase means we will record in the debit side. So 500 we will debit the 500 interest on investment account, then balance it off. The balancing amount will go to the statement of financial position. So the next one is rental account. So the credit side bank 3000 will take it from the trial balance, and then we have to debit the deferred rental in the rental account. 930, because we deferred rental will decrease our rental revenue account, so we have to debit the 930 deferred rental and then balance it of 3000 minus with 930, we will get 2070, and the 2070 will record it in the statement of profit and loss. So the next account is deferred rental account. We have to credit the rental received 500, because deferred rental is a type of liability, because we receive the payment in advance from the customer but we haven't provided our service, right? So it's a type of liability. So if a type liability increase means we will record it in the credit side. So 500 and then balance it off, the balancing amount will go to the statement of financial position later.
After you do the journal and ledger, you must open the statement of profit and loss. Under the statement of profit and loss, we just attract revenue part. Okay, under the revenue, we have three different items. First is commission received. How you get the 4600 from the amount the trial balance for 300, you must plus 300 from the additional information. Okay, for interest on investment, 5,000 from the trial balance, you must plus 500 from the additional information, and you can get 5,500. For rental received also, 3,000 from the trial balance, you must deduct amount from the additional information, 930, and you get 2070. After we open the statement of profit and loss, so we must open the statement of financial position. We have two components. We just attract current asset and current liability. Under the current asset, we have two different items, which is accrued commission and accrued interest on investment. While current liability, we have one item, is deferred rental.
Now we will move on to the question 2. The following is a trial balance from the book of Russia Amina bookstore on 31st March 2019. Below is the trial balance, and there are three different accounts with its amount on credit side, and those accounts are commission, interest and rent. Moving on to the additional information, the first information is the commission received in advance was 300, which means it is a deferred commission, as we already received the amount in advance but not yet provide the service. The second information is rent revenue is 370 per month, which means it is an accrued revenue, as the company has understated the rental amount. The third information is the unearned interest was 200, and unearned is similar to deferred, therefore unearned is also known as deferred interest.
Now, let's move to the general part. So the first one is from our first additional information, which is commission received in advance was 300. So in advance, it means it deferred commission. So in our journal, we will debit the commission received and credit deferred commission, with the amount will be 300. The explanation is commission received in advance. For the second one, from our second additional information, which is rent revenue is 370 per month. So if we time 317 with 12, we got 4,440. But in our trial balance, we only record it 2,850. That means the balance 1,519 will be our accrued rental. So for the journal, we will debit accrued rental and credit rental received. And the explanation will be rental payment not yet received. The third one from our third edition information, and it say unearned interest was 200. Unearned is so known as deferred. So this one will be deferred interest. Then we will debit the interest account and credit deferred interest with amount 200, and the explanation will be interest received in advance. Now let's move on to ledger part. The first thing is we have to open commission account. For the bank amount, we take it from our trial balance, which is 500. And we will debit deferred commission. Why? Why we need to debit deferred commission? Because deferred, we will deduct from our revenue account. Even though we have received the cash, but we haven't provided the service to our customer, and it will decrease our revenue. That's why we put it in the debit side. So the amount will be 300. We balance it off. The balance 200 will transfer it to profit or loss statement. The second one is deferred commission account. So for this account, we have to credit commission 300. Why? Because deferred account under current liability. When our liability increase, we will put it in the credit side and we balance it off. The balance 300, we will transfer it to the financial position statement. Next, we open the rental account and the amount bank 2,850. We take it from our trial balance. But for this one, we have to credit accrued rental 1,590 because accrued rental mean we have to add in our revenue account. So when our revenue increase, it will be on the credit side. That's why we credit the accrued rental. So we balance it off. The balancing 4,440. We push it to the profit or loss statement. Then we open the accrued rental account. For this account, we have to debit rental 1,590 because accrued rental under current asset. So when our asset increase, we will put it in the debit side. We balance it off. The balancing figure will transfer to the profit or loss statement. Next, we have to open interest account. For the bank amount 1,008, same as before, we take it from our trial balance. Then we debit deferred interest because deferred interest we will deduct from our revenue account. So when our revenue decrease, we will put it in the debit side. And the amount will be 200. The balance, we balance it off. The balance is 808. We post it to the profit or loss statement. The last one, deferred interest account. For this account, we have to credit interest 200. Why? Because deferred interest account under our current liability. So when our liability increase, we will put it in the credit side. We balance it off. The balancing figure 200. We post it to the financial position statement.
Next is the statement of profit or loss and other comprehensive income. As we stated before, there are three different accounts, and those accounts are commission received, rental received, and interest. For the first account, commission received, we have to deduct the deferred amount, which is 300 from 500. The second account is the rental received, and we have to add the accrued amount, which is 1,590 with the 2,850. And the last account is the interest. We have to deduct the deferred amount, which is 200 from 1,008. And the last statement is the statement of financial position. Under current asset, we can find accrued rental with the amount of 1,590. Under current liability, we can find deferred commission with the amount of 300 and deferred interest with the amount of 200. We would like to skip the part C and D as we already explained earlier. We will move on to the part E. Part E is about the analyzing the findings obtained from the comparing the treatment of first set of questions and second set of questions. So we have to find the similarities and differences between both sets of questions. As for similarities, we can say both sets involve the accrued and deferred items. Moving on to the differences, finding 1 is about commission received in advance. Finding 2 is accrued rent revenue on monthly basis.
Finding 3 is deferred interest. Deferred interest in second set is representing as a liability for interest income received but not yet earned. For finder 4, deferred rent revenue. In the first question, recognition of deferred rent reflects a liability for rent received in advance.
So in a simple form, deferred revenue means we have to deduct it from the revenue account. If accrued revenue means we have to add it into the revenue account. So in a conclusion, the second set question is contributing more understanding of revenue recognition and financial reporting. Hope you all can understand. That's all from us. Thank you so much for watching.